Stocks today doing pretty well indeed. As you can see, we've got the S&P 500 up 25. We've got the NASDAQ up 102, and we've got the Russell 2000 small caps. A little bit of negativity here going on. Joining me now, Cresset Capital Chief Investment Strategist, Jack Ablin. All right, my friend, welcome. It is time as the markets wait.
Hey, well, first of all, before I even say anything, Jerry, I didn't expect you to be here, but I did just download your book. Lincoln's Ladies Spy Master, and I'm looking forward to reading it over the break.
I love starting the show with an ad for my book. Jack, thank you for that. Let's talk Santa Claus rally, my friend. Are we going to get one this year? The official period, I think it doesn't start till tomorrow. And of course, we haven't had one for 2 years, but we've never not had three, blanks in a row. So this is according to market historian Ryan Dietrich. What do you think? We going to get one?
Yeah, I think so. It seems like the path of least resistance right now is higher. We had a very surprisingly strong GDP report in Q3, and yet interest rates really didn't spike. It did initially and then came back. So we're seeing a very tame interest rate environment. We're seeing a pretty tame inflation expectation environment. And so for that reason, I think that this momentum that we're seeing will likely continue for the next couple weeks.
Well, from your lips to God's ear, but let's focus in on that part of the market everybody's anxious about. We have a lot of anxiety over tech valuations. They've eased slightly. And you note that, of course, all of this AI valuation is more complicated than people think when they say bubble. Can you break it down for us? Why is this so complicated, and what do we need to be looking at?
Yeah, so first of all, let's dispel any notion that this is like the internet tech bubble of '99 and 2000. First of all, the valuations aren't anywhere near it. These companies are making tons of money and generating a lot of cash flow. The internet was certainly played out very, very well, but the market got way ahead of itself come 1999, 2000. That said, the internet platforms are these hyperscalers are spending upwards to $400 billion a year, and right now, total enterprise revenue from this space is $100 billion.
Unbelievable.
It is
it's
right
unbelievable.
Now upside down.
So let me interject a question here. How do you position yourself for 2026 given those incredible numbers?
Yeah, I think that one of the things we keep emphasizing to our clients and advisors is rebalance. Rebalance back to your long-term targets. If you want to wait till after January 1st, so you don't want to, push capital gains in the next year, go ahead. But really look at your long-term targets. What that means is selling the winners, buying the laggards, and just rebalancing. That also means probably buying some international, rebalancing back into small caps. And in an environment where we expect borrowing rates to come down, small caps could do remarkably well.
All right, fingers crossed. I like that. I've got to tell you, this is the best number we have in the show, besides the GDP number, which was great. New data from Bank of America showing that only 22% of actively managed large cap funds outperformed the S&P 500 this year. That is the lowest proportion since 2016. Now, for me, that means what I think is true, that individuals can invest their own money because maybe they will do better than these active managers. What went wrong for these folks this year?
Yeah, I think if you consider, Jerry, that the top 10 companies in the S&P comprise nearly half of the index, and those were the winners. And so an active manager that has to take a position to try to beat the index would mean that they'd have to, overweight an already overweighted sector. And that's very, very difficult to do. And many of them are just within their parameters, just can't do it. And so, our belief is we like passive investing mostly on the public side. And we really focus on what we call private market alpha. That's where we think we can get incremental benefit is really from the private markets.
All right, Jack, let's break down your stock picks here. I know that's why people are watching the show tonight, is to get these. Let's start with Renaissance Holdings. Why do you like that?
Sure. First of all three of these companies generate a ton of cash flow. That's really one of our underlying requirements. But Renaissance Re generates fees from a lot of different places: underwriting, fee income from investment management, and investment income. Rayonier owns 4.2 million acres of property in the Southeast. This is a timber play.
Right.
This is a real estate play, and one that if we start to see interest rates come down, or we see the Fed execute what I'll call an Operation Twist, where they start buying 10-year notes, this could be a huge beneficiary. And then lastly, Terex. It's it's a materials processing company. They do waste recycling, so that's really key. If we see inflation trend higher, they're also sell into the utilities market, very well positioned fundamentally right now, and then also serve infrastructure, another area that we like. Again, high quality companies with multiple ways of generating
cash
income.
flow. I love that. Jack, thanks for coming on. I'm going to have to go write another book, so you can buy another book. Thank you for that
Sounds good.
shout out.
I'll wait. Thanks, Jerry.
Thank you.